Hey everyone, my name is Caleb and welcome back to my channel. If you are someone who is new to investing and looking into different retirement options, this video is just for you because in today's video I'm going to be sharing with you the differences between a Roth IRA, a traditional IRA, and a 401k. For those who don't already know, these three things are basically retirement accounts and they're set up for long-term growth, so you just contribute money to them throughout your career, and then by the time you retire at 59 and a half or older, then you'll have a big nest egg for you. And typically these three things consist of different portfolios that are all comprised of different stocks and bonds. So I'll show my iPad here for a second to kind of show you what that might look like. So now this is just an example portfolio. This is a little bit on the aggressive side, kind of what your portfolio would look like when you're a little younger. But as you can see, we got the large company stocks here, maybe some medium company stocks and small company stocks, and then there will typically be some international company stocks and bonds. So the thing with bonds though is as you get older, generally speaking, what ends up happening, the share of bonds that you have, or the pie slice of bonds that you have, will increase as you get older. So maybe when you're like 45, your chart might look a little more like this. That's basically an example portfolio, and when you're putting money in, it'll go into something like this. And each part of the pie is usually going to be an ETF. It's not going to be an individual stock. So it'll be like, for example, the large company stocks slice will be the S&P 500, which is 500 different companies. And same with the other ones, it's usually a bundle of a bunch of different stocks, so you get a really diverse range of things that you're putting your money into. And that's kind of the point, is for it to be a little bit less risky than just, buying and trading stocks. That way you can be confident by the time that you retire, you'll have the money there available for you. So now I'm going to compare and contrast the three different things here and kind of just tell you the differences and similarities. So the first thing to mention, of course, is a Roth IRA is post-tax money, and a traditional IRA and a 401k are both pre-tax money. So when you work at a job and you get a paycheck and they tax your paycheck before you get it, basically the remaining money that you have left over is the money that you can put into a Roth IRA. So a Roth IRA is just post-tax money, it's already been taxed, and then when you retire at 59 and a half, all the gains and contributions you made in the account can be withdrawn tax-free and penalty-free. Whereas a traditional IRA, the money is going in pre-tax. So basically what this means is that you're putting money into it before it's taxed by your employer. And so if it's already taxed by your employer and then you add to a traditional IRA later, then you would have tax deductions at the end of the year and stuff like that. And a 401k, of course, they do that all automatically. And they will also match you some of the time up to a certain percentage. So for example, my employer will match 100% of my contributions up to 6% of my wage. So that's pretty good. And the major differences between these two is it really depends on when you want to be taxed. So say, for example, in the future you want to retire in a higher income bracket, higher tax bracket, then you'd be paying more taxes in the future if you were to be contributing to a traditional IRA, whereas if you did a Roth IRA, then by the time you retire, you would have already paid the taxes now when you're young and the taxes are cheap. That way you don't have to pay them later. So they're literally just opposites of each other, and you can really leverage the benefits from these if you know what kind of income you want to have when you're like 60 years old, because if you want to have like 60 grand a year and right now you're only making like 20 grand a year, then it might be better for you to contribute to a Roth now, because you're paying taxes when they're cheap, whereas later taxes might be more expensive. But if you're making a ton of money now and you're trying to retire with less money, then contributing to a traditional IRA would be better, because then you can pay the taxes in the future when they're cheaper. So I guess I can give you a quick example here real quick. So say that you get $500 on your paycheck from your employer, and you get taxed at 20%. So that would leave you with $400 left, because 20% is $100. So then you invest that money, and say hypothetically it grows to $4,000 over the next 40 years or whatever. So by the time you retire, you can withdraw that entire $4,000 amount totally tax-free, because you've already paid those taxes. Whereas with a traditional IRA and a 401k, say that you get $500 again, but it's invested immediately. And then what happens is this will grow to, say, $5,000, because the same growth rate here, I'm anticipating a 10x growth, so, times 10 on the growth. So $5,000, And then in the future, you get taxed at that same 20%, and you'll end up with that same $4,000 at the end. But as I was saying earlier, say for example, you get taxed at a rate of, let's see, we'll just double it and do 40% when you're older. So if you get taxed at 40%, then you would end up with only $3,000 left, which is obviously way less than the $4,000. Whereas if you were to be taxed at a lower rate in the future during retirement, say 10%, then you would end up with $4,500 left by the time you withdraw it. So that would be more than the $4,000. So that's pretty much what I'm talking about there. The 401k and the traditional IRA pretty much work the exact same, but there's a couple of other things about those two that I'll talk about in just a second. So moving on here, let's talk about contribution limits. So with both a Roth IRA and a traditional IRA, they both have a contribution limit of $6,000 per year. So that's about $500 a month. That's the most amount of money that you can put into these each year. But if you're over the age of 50, then you can contribute $7,000 a year. Then with the 401k, the limit is much higher. You can contribute $19,500 a year, but if you add the amount that you contribute plus what your employer contributes, your limit is actually $58,000. And then if you're over the age of 50, it's $26,000. So on to the next thing here, we got the distributions. So there's a couple of rules with how this works. With the Roth IRA, there is no required minimum distributions. That's what the RMD stands for right there. And basically what this means is you can keep the money in it until you die, pretty much. And then as soon as you hand off your account to a beneficiary, say when you die it goes to your next of kin, like your kid or something, then they will have the required minimum distributions as soon as it's handed over to them, which basically means that they have to take out a certain amount every year or they're penalized for it. And it differs depending on how old the person is and stuff like that. But with a traditional IRA and a 401k, these both have required minimum distributions starting at the age of 72. And again, this depends on your age at the time. And so, for example, say that you have a required minimum distribution of about $25,000 per year after that, and say there's like $1 million in the account. So if you don't withdraw the required minimum, then basically you'll lose 50% of whatever that number was as a penalty. So then you would lose half of that $25,000's value if you don't take it out. So that's kind of how that works. So Roth IRA is good, if you plan on contributing to it till you're like 80 or something. The other ones, of course, are limited to 72. So now there's some rules with withdrawing the money early. With a Roth IRA, basically you can withdraw any of your contributions at any time. So the money that you put in, you can take out at any time without any taxes and without any penalties. But if you take out any of the gains before the age of 59 and a half, you'll incur a 10% penalty and have to pay taxes on that. So if you wait until you're after 59 and a half, then all the money in the entire account is totally tax-free to take out, and there's no penalty. So because you, of course, paid the taxes when you deposited the money into the account. Now with a traditional IRA and a 401k, these are both the same with this, but the contributions and the gains before 59 and a half, if you take them out, then you'll have a 10% penalty and pay taxes, because with both of these, you still haven't paid the taxes on it yet. And then after the age of 59 and a half, you won't have that penalty anymore, but you'll still have to pay the taxes depending on your income bracket at the time. So if you have a ton of investments in the future that you're cashing out on, that could potentially push you into a higher tax bracket. So that's one thing to consider here when you're choosing which of these accounts you want to kind of prioritize. Now, there are some exceptions for all three of these accounts. You can withdraw, I think, up to $10,000 for a first-time home purchase. You can withdraw like $5,000 for a childbirth expense. And there's a couple of other things like disabilities and stuff like that, where basically you can take out a little bit of the money without having taxes or the penalty, but it kind of just depends. And talk to a financial advisor about this, please. And yeah, so that's pretty much all for that one. Now, moving on here to some other stuff and the age requirements here. So with the Roth IRA, you technically can start doing this as soon as you're 14, because that's the minimum age to be employed. And you can contribute to these and the traditional IRA as well as long as you have like an income source. So if you're just like mowing lawns and getting some money under the table, that doesn't count. It has to be money that's like reported to the IRS through an employer. So if you happen to have a job at the age of like 14 to 17, you can contribute to one of these if you have a parent involved. It's called a custodial account. And basically they have just parental oversight until you reach the age of majority, which in most states is age 18, but some places it's 19 or 21. As far as the age goes for the 401k, some employers will let you contribute to a 401k between the age of 14 and 20, just like the other accounts, but it's kind of up to the employer whether or not they want to do this for you. But as soon as you turn 21, the government basically requires all employers to have this available to you. So that's kind of how that works. And then a couple other things here. I mentioned rollover a couple of times at the bottom. Basically, with the Roth and the traditional, if you don't reach that $6,000 limit by the end of the year, say you only get $5,000 in, you have until the tax deadline of April 15th of the following year to get that remaining $1,000 into the account before you kind of start the countdown back over at zero again. Whereas with a 401k, you cannot do this. You have until December 31st to deposit everything that you want to have in there. However, your employer's contributions, they can contribute until their tax deadline. So it's kind of funny the way that works, but it's kind of nice to know that if you can't make the $6,000 by the end of the year and you're really trying to max it out every single year, you at least have a few months to kind of play catch up and deposit a little more into it. That's pretty much it. So the things to consider here, of course, the question is which is better out of the three? And it really depends. So how much money do you want to have in retirement? What I would do is kind of figure out how much money you want to pay yourself in retirement, say like, $75,000 a year, and then figure out how much you're making now and whether it's better to pay the taxes now or later. And of course, the other thing that matters a lot is how old you are. If you're younger, I usually recommend a Roth because typically younger people are in a lower income tax bracket, whereas when you're older, usually, you're getting raises and stuff at your job as you get older. Again, talk to a financial advisor about this. The other thing is your anticipated tax bracket, just like I mentioned earlier, because you definitely want to, kind of plan ahead a little bit because things like Social Security and stuff can affect your income in retirement, and that can maybe push you into a higher tax bracket than you thought you'd be in. And the other thing too is the government can just change the tax laws at any time. So say that you think that the taxation is going to be a certain amount when you retire, but then a few years before retirement, they, raise the tax rate higher than it would have been if you just contributed to the Roth IRA and paid the taxes when you were younger. So that's one thing to think about. The Roth IRA doesn't really have that risk because you know what the tax rate is just by Googling it. Whereas with the 401k and a traditional IRA, you're kind of having to assume the general tax rate is going to be what you think it is when you're older, and that could be decades ahead. Really anything could happen. Our tax rate could be 70% in 50 years, who knows. And what about other investments? So what if you have cryptocurrency? What if you have real estate? What if there's a bunch of other things that you're going to cash out on? How is that going to impact your tax bracket and stuff? So if you have any questions about this, please leave them in the comment section down below. I know that some of this could maybe be a little bit confusing, but I hope I cleared up some things for y'all about how these different retirement accounts work and how they differ. So I typically recommend for people to start a 401k with their employer just because you'll get that dollar for dollar match, like I said. And this is the most instantaneous 100% return on your investment that you could get. So I always recommend to do that up to the amount that they will match you. And then anything else is, totally up to you. And then a Roth IRA is good as your secondary main source. And of course, after that, there's plenty of other options. It's really up to you. But I think the 401k employer match and the Roth IRA are kind of like the backbone to the young investor planning for retirement. As soon as you're 18, definitely, hit up a financial advisor about this stuff and see if you can get your feet in the water and see how it works for you, because it will really make a huge difference if you start doing this early. So if you have any questions about this, like I said, please leave them down in the comment section below. If you like this video, please give it a big fat like. And with that being said, thank you so much for watching, and I'll catch you in the next one.